Welcome back, everyone, or anyone that just arrived. Welcome to the forum. This is the second session of the ASF 2012 conference, and in this session, we're going to hear about some perspectives from APRA and ASIC, and a quick reminder that if you have used your phones outside, put it back on silent if you can, and also your iPads too, put them on silent too, because messages can come through them. After the keynote speeches that we hear from over the next 15 minutes, you'll be given the opportunity once again to ask some questions, and you can send those questions through on a text message with the number 0429 883 481. We'll repeat that number a bit later. Just make sure you enter the code ASF 2012 and include a space before you type your question. And of course, you can send your messages through the sessions questions link of the app. Our next keynote speech is entitled Prudential Reform in the Australian Securitisation Market, and the keynote speaker is Charles Littrell, the Executive General Manager at the Australian Prudential Regulation Authority. Prior to joining APRA, Charles was an executive at Westpac. Charles is a member of the Basel Committee for Bank Supervision's Policy Development Group, and Charles is also a member of the Advisory Board for the Faculty of Economics and Business at the University of Sydney, and a member of CIRCA, the Securities Industry Research Centre for Asia Pacific. Why does finance have to have so many long words and long names? Charles Littrell, please welcome him to the stage.
It's my aspiration to some here give a speech at the ASF and people say, oh, there was nothing new this year. So that's not going to be this year's speech, or probably next year's. Today, I propose to briefly review APRA's take on the Australian securitisation market in the context of our statutory mission. Then I will outline APRA's current thinking on how to secure the benefits of securitisation for Australia while reducing the potential for problems that we have seen emerge over the last 5 years. Section 8 of the APRA Act states, APRA is to balance the objectives of financial safety and efficiency, competition, contestability, and competitive neutrality. And in balancing these objectives is to promote financial system stability in Australia. We actually read our acts and try to pay attention to them, and in my policy division, this is something we spend a lot of time on. APRA interprets the first part of this statutory instruction as an optimization problem. To wit, we seek to maximize safety constrained by the need to avoid undue damage to the Australian financial system's efficiency, competitiveness, competitive neutrality, and contestability. The second part of the statutory instruction adds the need to promote financial stability. So we end up with 2 objectives and 4 constraints. Most of you here will have studied economics, and you will remember the old saw about you can't have more objectives and constraints than you have tools, and fortunately APRA has lots of tools, so we can get away with 2 objectives and 4 constraints. How does securitization fit into APRA's objectives and constraints? From the 1990s to the mid-2000s, rather well. From 2008 through, say, 2011, less well. And today's talk is about how we get back to the rather well bit from 2012. In theory, and from the mid-1990s to the mid-2000s in practice, securitization was largely a winner in APRA statutory terms. Any glance at the spreads on home loans, for example, would suggest that securitization was helping quite a lot on competitiveness. A look at the names of the new lenders coming into that market suggested that competitive neutrality and contestability was going well. It's not only smaller regulated institutions, but a great many unregulated institutions were able to compete profitably with the largest Australian banks. There were some issues that we sort of finessed on systemic stability. The increased competition reduced the net price of home lending. That helped contribute to a market from, say, 1998 to 2003. Depending on your definition, that was a bubble or perhaps just a very frothy market in house prices and home lending. As it happened, APRA and the RBA used methods outside securitization to address that frothy market, and so far at least, we've avoided substantial problems in home lending. Globally, and in some instances locally, this benign view of the good fit between securitization and APRA's statutory objectives changed rapidly from 2007, and particularly 2008. The apparently inevitable rise of securitization in Australia reversed sharply, a trend which now shows some signs of moderating. And this chart, among many others, shows that trend. In traversing the last 5 years, we've learned at least 4 lessons about securitization, and unfortunately none of them terribly satisfactory from APRA's point of view. First, lending models based upon laying off all the funding and all the capital and all the risk to other parties, the so-called originate to distribute model, creates unacceptable agency risk. It allows lenders to lend without the constraints associated with putting their own money, or at least their shareholders' money, at risk. This too easily leads to an unrestrained focus upon lending volume and not enough focus upon lending quality. This lesson's global and has led to more focus upon skin in the game for the original lender, and any new Australian securitization arrangement will need to respect this outcome. Second, a number of international firms, using the complexities of securitization and structured credit more generally, created investments that were more likely to fail than was advertised. Australian regulated entities were the victims rather than the instigators of these schemes, which I suppose is of some comfort. Third, as illustrated on this chart, the securitization markets can suddenly close, even to the highest quality underlying assets in the simplest structures. Had the public sector not supported Australian securitization via the AOFM, then this chart would have been even flatter since 2008, with near zero issuance for approximately 18 months. The securitization market's vulnerability to near total closure means that liquidity risk is at least as high in securitization as it is in normal banking. The usual cautions associated with lending long and borrowing short apply. Finally, the fact that securitization markets can close even to good credits and for extended periods means that securitization-reliant business models are at risk of being placed in de facto runoff. This strongly suggests that no prudentially regulated lender should rely too heavily upon securitization for funding. As shown in this chart, closing securitization markets were an inconvenience for the largest Australian banks. They were a strategic constraint for some of our mid-size ADIs. Happily for our ADIs in the Australian economy, and in this particular circumstance, Australian depositors filled the slack for the global runaway from securitization, but we cannot always rely upon this outcome. In addition to these core lessons, you will recall that APRA last made substantial changes to its securitization framework in APS 120, taking effect from January the 1st, 2008. Our intent was, as a supervisory matter, to check the ADI's industry's implementation of the new approach, which, among other things, no longer required APRA pre-approval on each transaction. What we discovered in subsequent supervisory reviews was not always pleasing. Too many ADIs had engaged in securitization without completing some of the basic governance requirements, including board oversight. Some ADIs had interpreted the rules, particularly on risk retention, in a way which ranged between convenient and wrong. Less troublingly, but not well catered for in the current APS 120, a number of ADIs had commenced securitization for funding purposes only. From 2010 until now, APRA has issued a number of ad hoc industry letters. These letters are intended to allow the securitization market to continue until APRA has the ability to undertake more fundamental reforms to the relevant prudential infrastructure. For the past 2 years, Basel III has taken center stage for prudential reform purposes, and neither APRA nor industry has had the capacity to address securitization in any fundamental way. It is also the case that the Basel Committee and IOSCO, among others, continue to develop international frameworks for securitization, and APRA intends to comply with those frameworks as they reach completion. Happily, APRA's policy development capacity is now freeing up beyond Basel III. After conducting initial and informal discussions with some participants in the securitization markets, we are currently drafting a discussion paper to commence the process of prudential reform for securitization. In our proposed reforms, APRA intends to push 3 themes: explicitly catering for funding-only securitization, subject to some prudential limits, greatly simplifying the overall prudential regime, and addressing the lessons learned about securitization, which I previously referred to: agency risk, liquidity risk, and business model risk. I remind listeners that today's talk is not the discussion paper or the proposals. APRA has considerable work and consultation in front of it to turn today's themes into specific prudential reforms. We propose first to define the approach to funding-only securitization. Such an arrangement is characterized by 3 features. The originating ADI retains substantially all the credit risk and all the capital requirements associated with the underlying asset portfolio. APRA's prudential requirements will ensure that such arrangements are sensibly managed in liquidity terms, and we want to ensure that the issue is not a covered bond in disguise. Our current thinking is that we can achieve a sensible prudential outcome in the following way. The securitization structure is, speaking somewhat loosely, restricted to 2 tranches. The A tranche is senior and is likely to comprise approximately 90% of a typical home loan securitization. The expectation, though not the potential requirement, is that the A tranche would be AAA rated. All A tranche notes must be pari passu in a credit seniority terms, but the A tranche may consist of issues with varying maturity, meaning that the shorter maturities are in a repayment order sense, but not a liquidation sense, ahead of the longer maturities. ADIs would be free to trade in their own A notes and another issuer A notes. It is likely we would do away with the 20% rule on holdings. I know many of you love that rule, but we will somehow figure out a way to get rid of it. When ADIs trade or invest in those notes, it turns out that the current Basel II and Basel III rules are all set up to handle that. This leaves the B note, which in a funding-only securitization is simply held in its entirety by the originator. APRA's expectation is that the B note will comprise the current mezzanine and equity tranches of a securitization. APRA is still considering how best to ensure that liquidity is properly managed in a funding-only securitization. We expect that any new arrangement will include the following features. The structure is consolidated with the originating ADI for Basel III liquidity purposes. There is a supervisory expectation that originators will seek to match the underlying asset tenor with appropriate liability tenors. And there would be some limit on the proportion of an ADI's balance sheet that may be pledged for securitization purposes. This means that the originate-to-distribute model will not be available for the entirety or even the majority of any ADI's balance sheet. APRA will consider whether or not we continue with our current prudential preference for pass-through structures or whether we allow more freedom for date-based calls. This is doubtless a matter for consultation. I'm offering a particular prize for anyone that makes a strong argument for continuing with pass-throughs only, but I expect most of you will go for date-based. APRA observes that the largest ADIs are primarily interested in securitization as a funding vehicle, but some middle-sized ADIs in particular are interested in securitization not only for funding but for capital relief. This brings us securitization in a capital relief sense, which would boil down to find a third-party investor and sell them the B note. APRA's thinking is that ADIs would be allowed to pursue capital reduction to the extent that B notes are sold, but with a minimum retention on the order of 20% of B notes to reduce agency risk associated with unconstrained and non-recourse lending. This is the skin in the game requirement. The B notes would look quite different from the current mezzanine and equity tranche arrangements. They may not be rated, for example, and this is good from APRA's perspective. The A notes are intended for investors who want safety and the comfort of a strong rating. B notes are meant for investors who have themselves built serious credit analytic capacity, and in particular for investors who rely upon their own analysis, not a credit rating. APRA's expectation is that ADIs would place B notes with investors outside the ADI sphere. To this end, APRA intends to propose that ADIs holding another originator's B notes will attract a 100% equity deduction for any such holding. ADIs swapping B notes create no net credit transfer, but it does mean that the more informed lender has exchanged his exposure for a less informed secondary lender. In a systemic stability sense, this is not a good strategy. APRA would much prefer to see the B notes held by expert and much less levered investors, such as super funds or their professional funds managers or insurance companies. I note that APRA's B note thinking and resultant prudential capital arrangements have yet to be optimized with international skin in the game requirements and with issues such as the seller's share, LMI cover, and profits left in or expected by the securitization vehicle. These issues will doubtless feature in our upcoming consultation. APRA's prudential arrangements currently allow for synthetic securitization, under which an ADI can enter a credit derivative and claim capital benefits for loans remaining on the ADI balance sheet. For various reasons, ADIs have been slow to take up this opportunity. Thinking more in a systemic stability sense, APRA is increasingly unconvinced that allowing synthetic securitization is a good strategy for Australia. Accordingly, we are likely to commence consultation on the basis that synthetic securitizations will no longer produce capital benefits. Similarly, current arrangements allow for remarkably complicated and opaque resecuritization arrangements. They can be traded, held, and built by ADIs, often at low risk weights. It is not evident that these instruments have any practical use. It's painfully evident that these instruments have been acquired by investors, including Australian investors, who were unable to understand the risk inherent in them. Accordingly, APRA's likely position for consultation is that ADIs are expected not to hold subordinated securitization instruments or any resecuritization instruments, and any such holdings will attract an equity deduction. It will be up to industry to argue the case for more liberal treatment. Finally, APRA observes that there has been much discussion of master trust over the years. We will be interested to hear any views on how our proposed reforms might facilitate or retard the development of master trust. I editorialize in passing that any discussion that starts with, if only the government, the RBA, or someone else would buy the missing piece I can't sell to the private market, you're not going to get very far. I'll close by summarizing APRA's prudential objectives. First, we want to ensure that Australian securitization arrangements do not encourage lax lending or tempt market participants to take advantage of each other through excess complexity. Second, APRA expects that Australian A notes will be among the safest and simplest securitization investments available globally. This should help restore and protect Australian access to local and global securitization markets. Third, we wish to ensure that credit risk is concentrated in the B notes and that these notes are held in expert and properly capitalized hands. Finally, we want Australian securitization to be part of the solution, and hopefully a large part of the solution, to the Australian ADI industry's need to find more term liabilities. Conversely, we don't want securitization to create unmanaged liquidity risk. In summary, APRA aspires to a securitization market that is not coming up on the screen. It aspires to a securitization market that is simpler, safer, and ideally larger than the current prudential arrangements allow. Thank you for your attention.
Thanks, Charles. Everyone will be given an opportunity to send through some questions via text message or through the app in a few moments once we hear from Greg Tanzer, who is the Commissioner at the Australian Securities and Investments Commission. His address is titled Global Developments in Securitisation, Regulation and an ASIC Perspective. Now, Greg's been appointed an ASIC Commissioner for a 4-year term commencing on the 5th of March 2012. He served as Secretary-General of the International Organisation of Securities Commissions from 2008 up until early 2012. He's previously the Executive Director for Consumer Protection and International at ASIC, where he worked in various senior positions from 1992 to 2008, and before joining ASIC, Greg worked in the Australian Government Attorney General's Department and the Department of Finance. He is also a qualified solicitor and barrister. Please welcome to the stage Greg Tanzer.
Thanks very much, Ricardo, and thanks also to the Australian Securitisation Forum for their very kind invitation to me to speak here today. Today, I'd like to talk about developments in international regulatory reform of global securitisation markets, and in particular ASIC's ongoing work in this space. Our chairman, Greg Medcraft, who happens to be with us today, spoke about ASIC's strategic priorities when he presented here last year, but I'd just like to briefly reiterate them today. Our 3 key strategic priorities are to ensure, first, confident and informed investors and financial consumers; secondly, fair and efficient financial markets; and thirdly, efficient registration and licensing. ASIC's work with respect to securitisation falls into our first priority: confident and informed consumers and financial investors. ASIC has been working in a number of areas over the last few years to assist in restoring confidence in the Australian securitisation market and to encourage cross-border capital flows. These include international regulatory reform work, working with the ASF domestically to develop securitisation standards for industry, and ASIC's work in supporting the development of the corporate bond market. ASIC has also been involved in other areas of work which indirectly promote the restoration of confidence in securitisation markets, for example, through our regulation of credit rating agencies and credit providers. But if I could start by talking about international regulatory reform. In response to a request from the G20, the Financial Stability Board, or FSB, has been developing recommendations to strengthen oversight and regulation of the shadow banking system. Regulation of securitisation is one key area of this work. ASIC, for its part, has had active involvement and strong representation in the international reform work led by the FSB and, in particular, the International Organisation of Securities Commissions, or IOSCO. ASIC Chairman Greg Medcraft was recently elected Chairman of the Board of IOSCO, and he'll commence his term in March 2013. And ASIC is co-chair of IOSCO's task force on unregulated markets and products with the French securities regulator, the AMF. So why is this international reform work so important? Well, securitisation offers an important market-based source of finance and indeed an alternative source of funding for the banking sector at a time when funding diversification is sorely needed. The government also recognises the importance of securitisation as a source of funding to smaller lenders whose presence in the residential mortgage market assists in maintaining interest rates at competitive levels to enable more Australians to own homes. The recovery of sustainable and sound securitisation markets is therefore needed to play an important role in supporting economic growth. Prior to the global financial crisis, securitisation markets were global in nature with significant cross-border capital flows, and a return to cross-border issuance will underpin the recovery of these markets. Obviously, differences in regulatory approach between jurisdictions may impede the return of cross-border capital flows and thereby impede recovery of securitisation markets. The international reform work that's being undertaken seeks to recognise these differences in regulatory approach and address them where appropriate. Of course, the other factor critical to the recovery of securitisation markets is a restoration of investor confidence and trust, as I mentioned at the outset. And this is a core focus of the reform work being undertaken. For this to happen, securitisation must be and must be perceived to be a mechanism for managing and reducing risk, not merely a mechanism for transferring or hiding risk. And why is this international work so important for Australian markets? Well, over half of our pre-GFC investor base comprised foreign investors. The recovery of the Australian securitisation market relies very heavily on the return of offshore investors, so we must be mindful of international regulatory developments to remain competitive on a global scale. Turning then to the current status of IOSCO's work, IOSCO issued its final report prepared by the task force I referred to on unregulated markets and products in September 2009, which made recommendations about improvements in regulatory oversight of securitisation markets intended to assist in restoring investor confidence and market quality. These recommendations included requirements for enhanced transparency and standardisation of disclosure and risk retention, or skin in the game. There have been various consultations and reports issued by IOSCO since 2009, providing guidance to industry and national regulators on the implementation of these recommendations. Among these, IOSCO's April 2010 report on disclosure principles for public offerings and listings of asset-backed securities, IOSCO's March 2011 implementation report, and IOSCO's principles for ongoing disclosure for asset-backed securities, which is currently in final draft form. Most recently, the FSB, as part of its work in the shadow banking sector, asked IOSCO to undertake a stock-taking exercise on certain aspects of securitisation regulation and to develop policy recommendations as necessary. IOSCO recently issued a consultation report on global developments in securitisation, with a final report due for publication later this year, which outlined the results of IOSCO's stocktake on global securitisation regulation and consulted with industry on a range of key issues. Key questions asked of industry in this consultation included, concerning transparency, should issuers be required to provide investors with stress testing results or scenario analysis, and is there investor appetite for this? On standardisation, should industry be encouraged to develop best practice disclosure templates and pursue harmonised approaches? And on risk retention, Are there material differences in risk retention across jurisdictions? The focus obviously being on the EU and the US, and if so, what might be done about such differences? IOSCO's recommendations have not yet been finalised, so my comments today are about some of the early observations and findings from the consultation processes. On risk retention has been a key focus of regulatory attention since the global financial crisis and was a key focus of IOSCO's consultation. Risk retention is intended to avoid misaligned incentives arising in securitisation structures by ensuring that the originator sponsor has an interest in the performance of the transaction over its life, as Charles has mentioned. Differences in approaches to risk retention across jurisdictions have been highlighted and considered in the consultation. In particular, the emerging differences between EU requirements and US proposals are viewed by the task force and by industry participants as being significant in terms of their impact on cross-border transaction flows. The EU has implemented risk retention requirements for EU credit institutions through the Capital Requirements Directive, and these requirements are to be extended to other types of institutions such as insurance companies. The EU framework imposes the risk retention obligation on investors. US requirements are still being developed through implementation of the Dodd-Frank Act. Under the proposed US rules, the obligation is imposed on the sponsor and subject to various carve-outs for certain high-quality assets. In some other jurisdictions, market practice and industry standards exist or are being developed that provide for a similar outcome, that is, requiring meaningful exposure to credit risk to be retained by originators, thereby incentivising them to conduct appropriate due diligence on and monitor the underlying asset pool. Given the differences between existing and proposed frameworks and the different stages of development and implementation, IOSCO's approach is focused on working towards equivalent regulatory outcomes at each national level, rather than imposing prescriptive risk retention requirements for each jurisdiction. This work is ongoing, but current work seems to be favouring the establishment of domestic risk retention frameworks in each jurisdiction, and then harmonisation of the different risk retention approaches across jurisdictions via appropriate exemptions and adjustments in order to facilitate cross-border ABS transactions. Concerning transparency, the consultation responses regarding transparency acknowledged the benefits of clear and effective disclosure to assist investors in making informed investment decisions and understanding the risks inherent in securitisation, and in particular to avoid over-reliance on credit rating agencies. While CRAs obviously remain a useful tool, it should be recognised that they are only one tool in the kit in terms of an investor's assessment of a securitised product. This approach promotes the empowering of investors to make better informed investment decisions and to be responsible for those decisions. IOSCO's analysis indicated well-developed regulatory requirements or industry standards in many jurisdictions regarding upfront and ongoing disclosure for public or listed offerings of ABS, and a general level of consistency in the information provided to investors across jurisdictions. There was, however, certain information that IOSCO considers may assist investors which is not required in most jurisdictions, such as stress testing and scenario analysis. There was some divergence of opinion as to whether it was best for stress test results to be provided to investors by issuers, or more appropriate for investors to be provided the detailed underlying data to conduct their own due diligence and scenario analysis. Given the potential conflicts of interest that might arise in issuer stress testing, IOSCO's position seems to be falling on a requirement for investors to be provided with the necessary information for them to provide their own analysis, to perform their own analysis, although this is still under discussion. I think it's worth noting here that much of the backlash against securitisation at the outset of the GFC was based around transparency and complexity, While initiatives to improve transparency will better enable investors to take responsibility for their own assessment of securitised products, this does not exempt issuers from responsibility. We expect that issuers play a responsible role in bringing good securitisation products to market, rather than developing overly complex products. And we must be careful that issuers do not consider enhanced transparency for investors solely as a mechanism for limiting their own liability. Given the relatively vanilla structures typical of the Australian securitisation market, this is probably a concern more relevant to other jurisdictions. But overall, improved transparency and risk retention are key planks to restoring investor confidence in securitisation. On standardising disclosure information, the survey results indicated that while few jurisdictions require standard disclosure templates, there are significant regulatory and industry initiatives underway. While industry is generally supportive of the concept of industry best practice templates, it has cautioned that differences between structures and assets across jurisdictions must be taken into account in standardisation initiatives. In the Australian market, the RBA today announced its information requirements for RMBS to be accepted as eligible collateral for its new committed liquidity facility and its existing repurchase arrangements. We understand that the ASF may undertake a review of RMBS disclosure and reporting standards to ensure consistency with any new regulatory requirements that were not contemplated in the original drafting. So what's Australia's response to these international reforms? The reason I refer to Australia's response to these international regulatory reforms, particularly in our regard, and not ASIC's response, is that there are currently no regulatory requirements in Australia that mandate any specific wholesale disclosure content. So while Australian securitisation markets are limited to wholesale issuance, while they are, ASIC doesn't have the power to establish a disclosure regime for offerings of securitisation products or impose specific risk retention requirements. Therefore, ASIC strongly supports industry self-regulation and the work of the ASF in developing standards consistent with international reforms. The ASF has developed and implemented industry standards for RMBS, recommended as a minimum level of best practice for the Australian industry on all issues since the 1st of July last year. And the ASF has recently released similar disclosure and reporting standards in relation to ABS. We've also seen the ASF actively participating in regulatory consultations at the international level to represent the views of Australian industry, such as the IOSCO consultation on global developments in securitisation that I discussed earlier. In particular, the ASF's submission to this recent consultation noted the importance of the material differences in relevant risk retention initiatives, given the global nature of the securitisation market, and the importance of cross-border liquidity to the Australian market. ASIC supports the ASF in its establishment of a risk retention framework that satisfies IOSCO's objective of consistency in regulatory outcomes. I'd like to turn briefly to the topic of the development of corporate bond markets. Initiatives to encourage the development of Australian debt capital markets more broadly go some way to supporting a recovery in securitisation markets, particularly in terms of broadening the investor base for debt products and expanding debt issuance to retail investors. The main benefit to superannuation and retail investors is allowing diversification of portfolios across equities and fixed income products, where this investor group has previously had limited direct exposure. Developing retail and superannuation fund appetite for more vanilla debt products such as corporate bonds may lead to a broadening of the investor base for securitisation products in the future. And ASIC would support such a development to the extent that this does not compromise the protection of retail investors. ASIC has been involved in various initiatives to support the development of the corporate bond market. We've relaxed disclosure requirements by issuing vanilla bond class order relief in May 2010 to allow listed entities to offer vanilla bonds under a simplified prospectus regime. We've issued guidance on satisfying prospectus content requirements and how to present prospectuses in a clear, concise and effective manner for retail investors. We've been in discussions with Treasury regarding proposals to reduce directors' liability for prospectus disclosure. This work considers both civil and criminal liability of directors and is yet to be finalised. ASIC is currently undertaking work to facilitate retail trading of Commonwealth Government securities, which is important in terms of encouraging retail investors to diversify into fixed income products, but also in terms of creating a visible pricing benchmark for the corporate bond market. And ASIC's work in this space also extends to the education of retail investors to promote confident and informed investors, and we've developed an investor guide for investing in corporate bonds. I'd like to reiterate that while ASIC recognises the importance of assisting recovery in markets, we favour a balanced approach and are mindful of extending disclosure exemptions of reducing directors' liability too broadly. ASIC has also been involved in some other areas of work which indirectly promote the restoration of confidence in securitisation markets, for example, through our regulation of credit rating agencies and credit providers. Credit providers came under ASIC's regulation in July 2010 following the introduction of new responsible lending obligations under the National Consumer Credit Protection Act of 2009. These obligations are intended to raise standards in the consumer credit industry and include making reasonable inquiries into a customer's financial situation, taking reasonable steps to verify a customer's financial situation, and assessing whether the customer will be able to comply with their financial obligations under the proposed credit contract without substantial hardship. Our Regulatory Guide 209 on responsible lending conduct assists industry in understanding these responsible lending obligations. ASIC has also undertaken a number of targeted reviews of the responsible lending practices within the industry, including our 2011 review of the conduct of 18 mortgage brokers, particularly with respect to low doc residential loans. A further review of how credit providers in the home lending market are meeting their responsible lending obligations is currently in the early stages, with a public report scheduled for release in 2013. Another area of work which indirectly assists the restoration of confidence in securitisation markets is ASIC's enforcement action against fraudulent loan applications. ASIC has seen some falsification of documents in connection with loan applications, with offenders in the vast majority of instances being brokers who have created and submitted false documents in support of loan applications to lenders. Since 1 July 2010, ASIC has banned 3 finance brokers from engaging in credit activities as a result of fraud or misconduct relating to information provided in loan applications, and we have 17 ongoing matters concerning similar alleged conduct. Possible outcomes may be bannings and criminal charges. On credit rating agencies, ASIC and Treasury reviewed the regulatory settings for CRAs in mid-2008. To strengthen regulation of CRAs and increase ASIC's oversight of the Australian operations of these global businesses, from 1 January 2010, ASIC required CRAs to hold an Australian Financial Services licence. As AFS licensees, CRAs are required to comply with the general licensee obligations that go to integrity and consumer protection. In addition, CRAs must comply with specially tailored licence conditions that, among other things, require compliance with the IOSCO Code of Conduct fundamentals for credit rating agencies and the annual lodgement of a compliance report with ASIC. The IOSCO Code is comprised of measures designed to improve the quality and integrity in the rating process, the independence of CRAs and management of conflicts of interest, and transparency and timeliness of ratings disclosure and protection of confidential information. Built on the foundation of the IOSCO Code, Australian CRA regulation is consistent with global regulatory standards. Both the European Securities and Markets Authority, or ESMA, and the European Union have confirmed that credit ratings issued in Australia are endorsable for use for regulatory purposes in the EU, having found that Australia's CRA regulation is at least as stringent as that in the EU. In conclusion then, while ASIC has limited powers with respect to wholesale markets, we remain actively involved in work to assist the recovery of Australian securitisation markets, primarily through our participation in IOSCO's reform work and our relationship with the ASF, but also through our work in facilitating retail investment in corporate bond markets and our oversight of CRAs and the lending practices of credit providers. Through our active involvement in global regulatory reform work, we seek to ensure that there are no unintended detrimental regulatory outcomes for the Australian market. There still seems to be some way to go, particularly with respect to a global position on risk retention, and we expect to have more guidance on this with the release of IOSCO's recommendations by the end of this year. And through our relationship with the ASF, we will continue to encourage the establishment of an appropriate self-regulation framework to position the Australian industry as best practice amongst its global peers. The common goal is and will remain that investors can have confidence in securitised products, that the risks are both reasonable and reasonably disclosed, and that securitisation can then be an effective contributor to economic growth. Thank you for listening.
Greg, don't go too far. They're red because they're hot seats. And Charles, I'd like to invite you up as well so we can get through some questions. We've got about 20 minutes and we'll try to pump through as many questions as possible from the audience. So that number to text message your questions to is 0429 883 481. It's on the screen now, 0429 883 481. Type in that keyword ASF 2012, then a space, then your question, and think of it as a Twitter comment. Keep it to about 130 characters. That's what the system allows for. And if you want to direct your question to a specific person, maybe drop their name in that question also. So, guys, maybe if I throw one while we get some questions coming through. Firstly to Charles, you've expressed the view that securitisation gives rise to prudential concerns because of opacity and high risks. Is this a fair comment post-GFC among Australian securitisations?
I would like to think it's fair, but the Australian securitisation in the sense of how it's normally done is among the simplest in the world and the most straightforward. And certainly what we're looking at is intended to achieve that result. I should note, however, that securitization includes the investor side as well as the originator side. And a number of Australian investors have bought quite unfortunate securitization positions, mainly from offshore. And as the supervisor and regulator of super funds and insurance companies, and banks, we're interested in that too. So there is the issue of not only Australian securitization on the originator side, but the investor side.
It's got some questions coming through, so keep them coming through. We'll go through as many as possible. First one there, how can APRA feel satisfied that it is achieving its statutory objectives, particularly in relation to contestability and competitive neutrality?
Actually,
I am on news radar.
I know many of you assiduously follow APRA's online pronouncements, but we have a magazine called Insight, and in our next edition we'll have some analysis on those points. Competitive neutrality refers to the ability of different sorts of institutions, regulated, unregulated, and to compete for the same business. And contestability refers to the ability of new competitors to come in and old competitors to exit an industry. On that latter, it's essentially measured by some intensity of who's coming in and who's going out. On the former, by a sense of how concentrated a market is and what sorts of different competitors are in the market. Beyond that, I'll refer you to the Insight article that's coming out.
Just a clarification one there. Did Charles say B notes are not allowed to be rated? What if an investor wants the comfort of a rating?
No, my speech will be on the APRA website, and I presume the ASF website fairly shortly. What I said was B notes may not be rated. That wasn't meant to be an instruction. That was meant to be an observation. We'll see how the market evolves. And again, I don't know if B notes are going to play out the way I described today. We need to get through consultation to see. But there's no intent to prohibit anyone from seeking an opinion on anything.
One for you, Greg. How widespread is low doc fraud?
Yeah, it's a good question, I guess. I think that we have certainly seen cases presented to us of low doc fraud, and I referred to some cases where we've taken action with respect to, primarily this comes through mortgage brokers who've fraudulently filled out applications or changed applications on behalf of consumers. It's difficult to say how widespread it is. At the moment, there's quite a degree of controversy about a couple of particular exercises, particularly in Western Australia, that are giving rise to concern about low doc loans. In the past, I guess, we didn't see too many significant issues of fraud, or not quite as many as we're seeing now. So it's one of those things that we're very keen to get onto as soon as we possibly can, because this was obviously a significant factor in the growth of subprime mortgages in the United States.
Charles, will the two-tranche structure equally apply to securitisations by non-ADIs, but to which ADIs provide warehouse funding or term ARAN?
That's one of the issues for consultation. We'll see how it plays out.
Got another one there for you. Do you expect banks will want to provide liquidity in unrated B notes, which are 100% deductions from capital if they can't be on-sold?
I don't expect ADIs to have anything to do with other ADIs B notes.
Okay, Greg. The Financial Stability Board is looking at shadow banking, which of course includes securitisation.
Yep.
Which aspects of securitisation not currently regulated in some way gives ASIC cause for concern?
Yeah, I think what I was trying to cover in my presentation was the key aspects of that, really. There's a lot of attention on risk retention, a lot of attention being given to risk retention requirements, and it's for the same reason that Charles has given. I think that while securities regulators and prudential regulators have obviously different objectives and core priorities, in this area the interests are very much aligned, because what we did see with unrestrained securitisation was a problem with misalignment of interest, such that no one took a sort of long-term interest in the product, and that's a very dangerous thing when you're dealing with something that involves a long-term liability that's connected to the banking system at one end of it. So from all perspectives, the FSB work on this risk retention is quite important. I guess the other thing I'd say, very much from an Australian perspective, is that I do think that there's considerable value in the work that's being done by the ASF on transparency and disclosure, in particular standardised disclosure. Now, I think you can always argue that through the GFC, investors could have asked for that type of disclosure. They could have asked for more transparency, and these were very professional investors that by and large we're talking about here, and they didn't. So what advantage is there in actually giving them this disclosure? Isn't it just a cost? But I think it does reinforce the responsibility of investors to make a sensible investment decision. And I've got to say, unless there is some sort of compulsion to provide that information, either at regulatory or self-regulatory level, I fear that it will just be seen as a cost, and people will abdicate their responsibility in some way. So I personally think that while there's a lot of attention on risk retention and rightly so. The stuff around transparency and disclosure is equally important. And, the more you have to disclose that you've got no clothes on, the more uncomfortable that is. So the more you have to disclose that you're actually pretty well dressed, the more comfortable that is. So we see that as a very important way of getting comfortable securitised products, better securitised products out there. And I am speaking more from the global perspective, really much more than the Australian perspective in saying that.
Charles, we're getting a number of ADI-related questions, so let's hit through those.
All the tech geeks are here today, I can tell.
How about we go for, will the current concession for capital treatment for ADI issuers that are holding B notes in their own structures be extended beyond?
Okay. Let me answer generically on current arrangements. There will be some sort of transition sorted out. But again, we have to do the consultation on what the new arrangements will be before we worry about what the transition will be.
Okay. Let's just go to, just so that we're proving to you, we are asking the questions that are being sent through. Charles, again, do you expect limits on the proportion of an ADI's assets that can be securitised to apply to self-securitisation?
Not this limit. I do note, however, that self-securitization for the purposes of the CLF and liquidity are caught up by a different set of rules. So it's that set of constraints will be adequate for self-securitization.
Can we go back to the master trust issue, because that was spoken about in our first part of the afternoon today. Charles, do you support master trusts in principle, and if so, why?
Do I support market?
Master trusts.
We don't support or not support them. If the market evolves where master trusts work within particularly the spirit and as well as the letter of the prudential rules, that's great. Having spent a long time in this market, I would say we have often had this conversation that goes, oh, here's a great master trust arrangement, if only. And if only the taxpayer would be on the hook for the bit of the master trust arrangement I couldn't figure out how to make work. So if only the RBA would guarantee the liquidity on the bullet notes rolling. If only the AOFM would buy the tranche that no one else will touch. This is not master trust. This is self-interested pleading. And we are against self-interested pleading. On the other hand, there's nothing particularly good or bad about master trust. And if someone thinks that would be a good way to get more market and securitization, and they can engage in our upcoming consultation on how to do that, well, great, let's have a talk.
One more for you, Charles, there. Has APRA considered
I'm
that...
going to have to charge you extra for this,
You're doing fine.
Has APRA considered that the B note may not meet mandates of any Australian investor?
Yes, we have. And if it doesn't, that indicates that the capital relief for securitization is not very well founded now. We will see how this plays. Again, there will be a consultation. But the idea is securitization will certainly support A programs that have tranches of fairly straightforward credit risk. And the people that buy into the A tranche will be mainly, I think, focused on payment patterns and not so much on credit risk. The B notes are more of a not speculative, but specialized investment. If that investor class doesn't exist, well, that would be an interesting consideration on the capital relief we're granting now.
Greg, if we bring it back to you, would you encourage the industry to list as a matter of course its securitization tranches, and would this foster transparency, consistency and liquidity?
Look, I think there's something in the argument that listing would facilitate or improve transparency and some level of standardisation of disclosure. It probably also would bring with it a degree of independent interest in the particular instrument that would also be welcome in terms of independent scrutiny or people making judgments about the worth of those sorts of instruments. From the liquidity side, I think sometimes that might be overstated. Obviously, one of the reasons for listing is to look for liquidity, but generally speaking, a number of the instruments that we're talking about might be relatively thinly traded, and just because you get it on a market, it won't necessarily relate in a great flood of liquidity. I guess from our perspective, what we see is that there is real value in expanding the investor appetite for debt instruments, whatever they are. So if that starts with vanilla bonds, if it, Commonwealth Government securities, but they're pretty hard to get, but starts with vanilla bonds and looks at securitized products, we think that broadening of investor appetite, and indeed a broadening of the types of products that are available, particularly in the fixed income space, would be a good thing overall for the investment environment in Australia.
As a follow-up there, a question for you. Is ASIC happy for retail investors and SMSFs to buy B notes?
Well, I think I'll take that on notice. I mean, the B note issue, in the way that Charles has described it, obviously is relatively new for us to look at. Yeah, I think as Charles describes it, it is a fairly specialised sort of instrument, and the risk that people are taking on needs to be very well understood. We are on record as saying, with respect to all sorts of exotic instruments, that there's nothing wrong with risk per se, provided that's, and nothing wrong with risky products being sold to investors, provided that can be adequately disclosed and people can make a reasonable judgment about them. So I think it depends very much on the complexity of the instrument and how reasonably you can disclose this. See, the flip side of the argument is that people should not be able to engage in that, and therefore should be able to share in the higher return that those products carry. As I say, we've been on record, particularly with things like hybrids, as saying, well, if the risk is a certain degree, then you'd think the return should also be a certain level. And we've seen that with some retail offerings, that the return just doesn't seem to be there for the level of risk that's going in. And that's the type of thing that ASIC would have a concern about. But generally speaking, the investment regime in Australia is a relatively permissive one, provided you're not misleading and deceptive, and providing you adequately disclose the risks and returns. But as I did make a point a couple of times in the presentation, there is a responsibility, I think there is a responsibility here on issuers to come up with good investment products. If they're good investment products, they'll sell, and they'll certainly be interesting at the wholesale end, and then you would expect that there'd be interest at the retail end also. Where we start to worry is where people try to flog product off at the retail end that a wholesale investor would not possibly be interested in, because the risk and return ratio is way out of whack.
Okay, this system's very good because you get a bit of a heads up as to which question's coming up next. Charles, could you elaborate why you're unconvinced about the merits of synthetic securitisation?
A couple of reasons. One, if we think about AIG financial products as a leading example, we fear that there's a systemic risk of somebody becomes the market leader of providing the derivative hedge. A lot of people buy that cover, and then that provider falls over. And people can talk till the cows come home about collateral and the rest of it, but that's not particularly safe. The other issue in a systemic sense is the original lender knows more about that portfolio than anyone else. So if they're offloading the putative risk, that's not net improving the stability of the Australian system.
Can I just add to that, Ricardo, perhaps? This was something particularly that I recall from my previous role with Hyosco, and it links to that point that I was trying to make before about products that have got some value to them. If the synthetic securitisation is primarily there to provide nothing more than leverage, there is a good question about what the social utility of that is. Apart from helping somebody who's got leverage risk, leverage risk, take on a leverage position. But from a from a social utility point of view, I think there's a good question about what value it provides outside of for the person who issues the product.
Charles, can Class A be AA rated or lower?
That, again, is an issue for consultation. My expectation is if someone particularly is looking at a funding-only deal, they're not going to mess around in the last few percentages of the asset pool and blow a AAA rating. Our current positioning is we'll see how the consultation emerges on this. We don't have it in an intent to impose a certain rating. It's more of an expectation of the way most people would do business.
Got another one there. Will APRA allow over-collateralisation, and how do they see this as differing from allowing mezzanine positions in structures?
That's 2 or 3 questions for the price of one. But over-collateralisation in this, you would have noted on the slide I said, or in the speech, we're trying to avoid disguised covered bonds. So there is an issue of over-collateralisation that we would have to deal with. Beyond that, it's a fairly technical question which we should deal with in the consultation.
Greg, how does your approach to securitisation regulation differ from our global peers? And does your approach mean Australians will be more, less safe or competitive than those competitors?
Yeah, I think, well, one obvious way in which it differs is that we do not, ASIC doesn't have direct regulatory power with respect to disclosure in the wholesale market. And while Australian securitisation is largely, wholly at the wholesale level, that means that ASIC is in the position of directly imposing regulatory requirements, which is why we're very keen to work with the Securitisation Forum on promoting self-regulatory initiatives in that area. That said, the overall approach here about transparency and standardisation, and indeed the approach with respect to risk retention, I think is all aimed at achieving a similar regulatory outcome or the same regulatory outcome as what we see in other jurisdictions. So I don't see that there's any particular issue for Australian investors being protected any less or indeed any more than counterparts elsewhere. And because it is such a global market, we expect that for Australian issuers going abroad, they'll be meeting the international requirements in any case, and that'll flow through to our market.
Charles, I want to give you the chance to answer that too, but let's go through some of those questions that we're getting first. Charles, do you think that the 2-tranche proposal will disadvantage any particular group of ADIs?
I think the 2-tranche approach will clarify funding-only securitization, which is allowable now, but as I said, not particularly well catered for. On current patterns, the largest ADIs tend to prefer funding only. The middle-sized ones are often seeking capital relief. Whether this is an advantage or disadvantage will depend on how we go with the final rules and what the market shapes up as. I do note, however, that we don't view advantage and disadvantage in the sense of who has the most market share. There's an important issue in terms of ongoing survival here. You can't be competitive if you've failed, and you can't survive for the long term if you're not capitalizing your risk. So we want to make sure that the mapping of risk and capital goes well.
I'm not sure if we've spoken about timing, but the question there is, can you give the market some indication of the timing of publication of this discussion paper and the current plans for the timing of the reform process?
Yes. As an indicative outcome, we wouldn't think the new arrangement would come in before 2014. So 2013 would be devoted to refining what the reform is. Currently, we are progressing major prudential reforms for all of ADI's, life insurance, general insurance, and super and conglomerate groups. And we're assisting our Treasury colleagues look at a substantial legislative reform. So we in industry are quite busy. I can tell you that inside APRA there's a reasonable consensus forming around what the discussion paper should say. When that actually issues remains to be seen. I always prefer Christmas Eve, but many in the industry suggest that that's not the best day to put out a consultation paper. So I will say I would think it would be early next year, but it is not going to be a case whenever we issue it that it will be a terribly short period to consult. There will be a couple of rounds of grinding through, and we have enough time in 2013 to do that.
It's funny you say that. When I worked for David Koch when I was younger, he always said the busiest day for finance news is that Christmas period.
That's true. That's the people we supervise, not us.
Maybe a couple of final questions. Charles, how does your proposal impact asset-backed commercial paper markets?
I didn't really talk about that much here. One of the issues we're looking at is any market which is funding to the contractual maturity but has a longer business maturity is taking a substantial liquidity risk. So if you're funding a set of contracts where you really are willing to let them run off and not replace them, then asset-backed commercial paper with short tenors works fine. But if you're funding a business line that you can't get out of in the short term, even though the contracts are short term, like credit cards, we will probably put some more emphasis on to ensuring that the business model risk of finding yourself an instant runoff in a business you don't want to be run out of is dealt with. So yeah, there will be some substantial issues on asset-backed commercial paper, and that will emerge in the consultation.
Okay.
I think that'll probably be also picked up in the FSB's work, really. That'll be part of the international regulatory reform, I think.
Okay, we'll have to leave it there. Greg Tanzer and Charles Littrell, thank you very much for your time. A round of applause for the gentlemen. Thanks, guys. And should also let you know at this year's conference dinner, 7-time world champion surfer Lane Beachley will be speaking. Lane has kindly donated a signed surfboard with not only her signature but a number of high-profile Australians to be raffled off to raise funds for the National Breast Cancer Foundation. Tickets are only $25 and can be purchased from the ASF booth. Support the cause and give you a chance to win. Doors have been open. I would now like to invite you to the networking drinks in the exhibition space just outside. Hope you enjoy the afternoon.